Now we will start with our Certified Management Accountant course. And the first part we will study is part A. In this part, we will have a chance to study about external financial reporting. And now we will come to the first item, a review of financial statements and income statement. In this chapter, we will have a chance to study with the four purposes. The first is identify the uses of financial reports and their needs. The second is distinguish between balance sheet, income statement, statement of changes in equity, and statements of cash flows and their purpose. The third, we will identify some inherent limitations in financial reporting, and the last but not least, methods of preparing income statements and other comprehensive income. And now we will come to identify the uses of financial reports and the list. As you can see on the table, for internal users of financial reporting, they are managers and employees. They also use financial statements to make decisions affecting the operations of the business. These users include management, employees, and the board of directors. And for external users, we can see that we separate them into 5 items. Shareholders and prospective investors need information to decide whether to increase, decrease, or obtain an investment in a firm. Creditors need information to determine whether to extend credit and under what terms. Financial advisors and analysts need financial statements to help investors evaluate particular investments. Stock exchanges need financial statements to evaluate whether to accept a firm's stock for listing or whether to suspend the stock's trading. And regulatory agencies may need financial statements to evaluate their firm's conformity with regulations and to determine price levels in regulated industries. Now, we will come to distinguish between balance sheet, income statements, statements of changes in equity, and statements of cash flows and their purpose. As you can see on the screen, the objective of financial statements is to provide information about the financial positions, financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. And you can see the 5 financial statements here. Financial statements complement each other. They describe different aspects of the same transactions, and more than one statement is necessary to provide information for a specific economic decision. The components of one statement relate to those of other statements. Among the relationships are net income or loss from the statement of income is reported and accumulated in the retained earnings account, a component of the equity section of the statements of financial position. The components of cash and equivalents from the statements of financial positions are reconciled with the corresponding items in the statements of cash flows. Items of equity from the statements of financial position are reconciled with the balances on the statement of changes in equity. Ending inventories are reported in current assets on the statement of financial position and are reflected in the calculation of cost of goods sold on the statement of income. Amortization and depreciation reported in the statement of income also are reflected in assets and liability balances in the statement of financial position. Financial statements are prepared Financial statements are prepared under the accrual basis of accounting. Accrual accounting records the financial effects of transactions and other events and circumstances when they occurred rather than their associated cash is paid or received. Revenues are recognized in the period in which they were earned, even if the cash will be received in a future period. This is referred to as the revenue recognition principle. Expenses are recognized in the period in which they were incurred, even if the cash will be paid in the future period. Under the matching principle, expenses are recognized in the same period as the related revenue. Expense recognition principles associate cause and effect, systematic and rational allocation, and immediate recognition. As you can see on the screen, there are some inherent limitations. Periodicity does not share the nature of the business, but only shows a certain period of time. About historical information, figures, of course, are reliable and accurate, but over time everything can change. About valuation, the valuation model refers only to book value, not market price. About accounting method, due to the choice of accounting methods and transaction accounts, it is difficult to compare between the two organizations. And the last but not least is the omissions. Some items may be missed